Hi, I'm Matt Bacon, and I am one of the lead financial advisors here at Carmichael Hill. And when we're talking about the impact of interest rates rising and what that means for U.S. exports and a stronger dollar, it means a couple things. The first thing is when interest rates rise, the dollar and U.S. dollar denominated products, financial products anyway, get a little bit more attractive. And foreign investors are enticed to dump the investments they have that are denominated in the local currency and buy US dollar denominated products, usually bonds, maybe things like treasuries, for example. So imagine that, I, Matt Bacon, am the pension manager for the South African Teachers Pension Fund. And I've got a lot of these South African bonds, they're denominated in Rand, and I see that interest rates in the US have jumped up, and all of a sudden I think, wow, what a great deal. Treasuries are paying more, it's pretty safe stuff. I like them more than the bonds I currently have. So I'm going to sell my Rand denominated South African bonds, which in order to do that, I've got to cash out of the Rand, convert that currency into dollars, and then buy the dollar denominated product. And when I do that, when I dump the Rand and convert it over to dollars, I am effectively decreasing demand for the Rand and increasing demand for the dollars. And this has this effect of essentially strengthening the value of the dollar relative to the value of the Rand in this example. So that currency decreases relative to the dollar. And that has an effect in whichever country the pension fund manager in my example is in, right? So we're gonna have a strengthening dollar as a result of those rising interest rates. Now, currency movements, that's obviously not the only thing that impacts them. There are a lot of factors that go into it, but rising interest rates, higher interest rates generally correspond to a strengthening dollar abroad. And that also has an impact on US exporters, particularly in the manufacturing sector. Because if all of a sudden the dollar is worth more relative to local currencies, it means that anybody that wants to buy goods made in the US and shipped abroad is now going to be paying just a little bit more for them because that dollar increased in value relative to my local currency. So I can't buy as much stuff from the US as I used to be able to, right? So we're going to see a slowdown generally in manufacturing and some other sectors. Really anybody that exports stuff that's made in the US abroad is going to see a slowdown in their business. And that is going to have a generally cooling effect on the economy. And so when you look at the stock market, stock prices, things like that, you will see perhaps a little bit of a bump up as people buy into things that are maybe paying more, like the safe stuff, treasuries, and you might see a little bit of a bump down in some things like manufacturing and related sectors in the stock market as the interest rates rise, as dollars strengthen relative to other currencies. So I hope this was helpful. I hope it put a couple things in perspective for you. If you have any questions, want to learn a little bit more about how these kind of things work, reach out to us. We're available to help you. Thanks.